Welcome back. This is Ask the Compound, the show where you ask and we answer. I'm your host, Ben Carlson. Let's say you have a portfolio managed by a financial advisor, but you also have a brokerage account, maybe a Robinhood account, that you personally manage, and that brokerage account is outperforming your financial advisor managed portfolio. Should you fire your advisor? We answer that question and more on today's show. Please stick around. Our email here is askthecompoundshow@gmail.com. On today's show, we're answering questions straight from you, our compound audience, about historical returns on the S&P 500. Can we trust them? Is it possible to buy a Porsche for $20,000 or less? That question came straight from a guy named Duncan.
I said in the 20s. Just
Hey, we're going to litigate it today. How should you think about private investment opportunities in individual companies, maybe from your friends? How can you diversify beyond the Mag 7, maybe to the S&P 493? And how should you judge the performance of your financial advisor? Remember, everyone in the live chat, hit us up as always. We'll answer questions live on the spot. All right, today's show is brought to you by our friends at Rocket Money. With prices going up on just about everything lately, dealing with money can be stressful. Trying to manage subscriptions, track spending, cut costs can feel overwhelming. Luckily, Rocket Money can relieve some of that stress and help you feel confident in your financial decisions that you make. Rocket Money is a personal finance app that helps you find and cancel unwanted subscriptions, monitors your spending, and helps lower your bills so you can grow your savings. If you've got a goal you'd like to save for, Rocket Money can even analyze your accounts and find the best time each month to put extra money aside. Get alerts if your bills increase in price. I get this all the time. If there's unusual activity in your accounts, if you're close to going over budget, and even when you're doing a good job, they'll give you a pat on the back, I guess. Rocket Money's 5 million members have saved a total of $500 million in canceled subscriptions, with members saving up to $740 a year when they use all the app's premium features. Cancel your unwanted subscriptions and reach your financial goals faster with Rocket Money. Check out rocketmoney.com/ATC today. That's rocketmoney.com/ATC, or just download the Rocket Money app on your phone. All right. Let's do it, Duncan.
So before we dive in, I just want to mention we're climbing the Apple podcasting charts, Ben. So
right.
It's and on YouTube we're trending up. It's looking up for ATC. I think we hit number 59.
I never follow any of this stuff, but I'm glad
we hit number 59 on the business charts, which is a bigger deal than the subcategory of investing, which we've always done pretty well on business. I think we were in the 50s last week. So
credit to the audience for asking good questions.
Thanks so much. Thanks, everyone.
All right. Let's do it.
Up first today, we got a question from Dave. Long-term S&P return figures are often cited going back to 1926. While nearly a century of data sounds impressive, investors couldn't actually buy the S&P back then. The index itself wasn't introduced until the 1950s, and it wasn't until the mid-1970s with Bogle's index fund that investors could purchase it as a single investment. Do the 50-year return figures since Bogle's time track closely with those long-term projections back to 1926, or does the modern era show notable differences?
Okay, Dave is very up on his market history. And this is a total Ben question because I love stock market history so much. So the Standard Statistics Company, they did not merge with Poor's Publishing until 1940, so it's just called Standard Statistics, hard to say. They originally began tracking in the 20s 233 stocks, but it was way too hard to maintain hourly or daily prices, so the S&P 90 was created. And it's kind of funny, all the other 100 and change stocks, they looked at their prices on a weekly or quarterly basis. That's how often they were updated. And the S&P 90
you would
was
probably
updated
like
on
that
an
today,
hourly
wouldn't
basis.
you? You would like just quarterly prices?
Yes, it'd be great, right? So in 1926, they launched the S&P 90. It was 50 industrial stocks, 20 railroads, and 20 utilities. That's it, right? In 1957, the S&P 500 was created. That was 425 utilities, or industrials, 60 utilities, 15 railroads, all New York Stock Exchange listed, covered 90% of the U.S. market value, okay? I think today it's like 80 or so. Then in 1976, the year that the first index fund from Vanguard came out, they revised it and they added financials. So you did not have financial stocks until the mid-70s, and because a lot of them, I guess, were over-the-counter traded. Duncan, you probably would have been trading them at a bucket shop back in the day.
Oh, definitely.
Instead of Oatly stocks.
Reading that Jesse Livermore book, yeah, it makes it sound kind of fun. Other than him getting kicked out of all the places.
It actually does sound kind of, yeah. I mean, it sounds like you're going to a casino, essentially. Yeah. So Vanguard launched as the first retail index fund in 1976. And it's funny, Bogle in one of his books said that they only really bought 280 stocks because it was too cost prohibitive to buy all 500. So they got the ones that covered the biggest chunk of the portfolio. I'd probably covered 95% of it, and it was close enough. And then it wasn't until 1988 that they got out of this fixed 400, 40, 40, 20 model, and it was industrials, utilities, financials, and transports. And then they like became more adaptive to the economy. So you're right. The way that the market has shifted over time, and now it's 35% tech, but realistically, we're probably talking 45 or 50% tech based on how the companies are categorized. So it's changed a lot over the years. So there's the history lesson. Now let's look at the actual numbers. So I have good data from DFA. They have this Returns 2.0 research database that goes all the way back to 1926. So from 1926 to 1956, hang on, take that off. No chart on yet. Wait till we get through them all. Jump the gun there, guys. From 1926 to 1956, the S&P compounded an annual rate of 10.1%, which is not bad considering that in the Great Depression, the stock market fell 85%. So I think if we went from like the mid-30s, it would be more like 12%, but still, that's what it was, 10%, basically the long-term average. Then if we went from 1957, when the S&P started, through July of this year, we're looking at 10.6% annual returns. So that's pretty close, right? A little better. Take the Great Depression off there, it's probably pretty even closer. Now, the IPO for the Vanguard S&P 500 Index Fund was August 31st, 1976. So if we start from the beginning of September, going through July of this year, S&P is up 11.8%. All right, now chart on. So again, we're looking at 10.1% from the mid-20s to the mid-50s, 10.6% since the S&P started, 11.8% since the Vanguard S&P 500 Index Fund. So it's kind of funny that the first index fund, the returns have been great since then, even better than history has showed. Now you could say, well, that's because the 80s, low interest rates or high rates going to low rates, whatever it is. I'd say that all of these periods cover a pretty wide range of market and economic environments. And I think, I think, can you trust the long-term data? I think so. This looks pretty good to me. Obviously, a lot of it is someone's been recreated, and he's right. You couldn't actually buy this stuff until the mid-70s. Even when you could, there was an 8% sales load on that very first Vanguard index fund. They got rid of it a few years later, I think, but it's way easier now than it ever was.
That means you would pay 8% up front on the transaction?
Yeah.
Wow.
8%. So, yeah, it was a lot harder to invest back then. And that's why so many people were mostly buy and hold investors back in the day. They'd buy dividend stocks and sit on them forever because it was so expensive to trade, which shows you that sometimes the barriers to entry are actually a good thing, not a bad thing. Now you can just flip your portfolio over in a day and it doesn't matter.
I'll take my free trading.
All right. It's like an open bar at a wedding. Like you have to drink more. It's impossible not to. It's free, right? Just like you have to trade more in your Robinhood account. All right. Let's do the next one.
Okay. Up next, we have the one that everyone's here for and everyone keeps talking about. Is it possible to buy a used Porsche for $20,000? Just for the record, again, I said in the 20s, not for 20. But
okay. If you missed it a couple weeks ago, we had a question from a guy who wanted to buy a Porsche, but he was worried that the personal finance community was going to revoke his Millionaire Next Door card, right? So I said he should rent one first, and you said, listen, you can get a used one for $20K-ish, and everyone in the chat just demolished you.
Right.
That the rest of the show was people in the chat demolishing you, saying, Duncan, there's no way. Duncan doesn't know what he's talking about. I'll be honest. I thought you were crazy too. But we heard from our resident car expert, so let's bring him on, Mr. Barry Ritholtz, coming to us live from the Bloomberg Studios.
Hey, Barry, you're muted.
For a change. Hey, guys, how's it going?
All right, so Barry, you have a Porsche, maybe two, so you're the perfect person to ask for this. You started sending us some used stuff because you're on all these cars. If anyone needs a car, go to Barry. Was Duncan nuts? Can you get a used Porsche for $20K-ish?
You could get a used Porsche for $10K, but keep in mind the most expensive car you'll ever buy is a cheap Aston Martin because of the repairs and maintenance. And first of all, what are we talking about when we say Porsche? I think most people think of the classic 911, a little harder to get for 20 grand in good operating condition. There are tons of Panameras, the four-door sports car, that have been out for about 15 years that you could find for 15, 20, 25. If we look at the Cayman and the Boxster, which is the smaller car, but almost the exact same engine, and really a mid-engine, not a rear-engine car, there are lots of those for 15, 20, 25. You have to go down the rabbit hole a little bit and educate yourself about what's risky in those cars. For example, the first generation Boxster had notorious problems. And the 911s from like 1998 to '05 had this bearing issue that was an expensive repair.
So wait, so you're going to be doing a lot of work on this, obviously.
Well, if you just go out and say, "Ooh, that's shiny, let me get that." But if you do your homework, like every generation car has its own tweaks. So like a 2010 Boxster, as an random example, you got to watch oil. Sometimes there's a leak. There's a seal in the back that sometimes leak. You don't want to lose all your oil. There's some electrical gremlins, but you get a well sorted out one. You always do a certified, a pre-purchase inspection from a certified mechanic who will say, here's what's good about this, here's what's problematic, and here's what's a possible issue down the road. So at least you can say, all right, I have $5,000 worth of repairs over the next 10 years. I'm going to build that into my budget.
Duncan really just wants one on cement cinder blocks in his front yard so he can wear a Porsche hat and a jacket just to tell people he has one.
I really like the 1980s turbos and Targas. Those are
So
cool.
what I like to do, and we are all about understanding depreciation, I like to find old ratty cars that have been abused, buy them for 60, 70 cents on the dollar, and then end up with a car that's worth more than
Barry's a Ben Graham guy when it comes
You're
to
a value investor, yeah.
So my Cabrio is a 1988. The previous owner had raced it. It had the 5-point harness and just all this. So it took me about 2 years to pull all that crap out. I restored it back to stock. It's probably worth 25 grand more than I paid for it. If you could buy a car, drive it for 5 or 10 years, and then sell it for what you paid for, that's a giant win.
Right, you showed us a few that where people have bought these in the past and have actually appreciated if it's the right car.
So there's a aberration because of the shortage of cars in the 2020s, because of the pandemic. So there's an artificial, hey, I paid 100 and it's worth 100 5 years later. But under normal circumstances, most of the depreciation takes place, like the big chunk takes place in the first, 3 to 5 years. I love buying cars right off lease. They're 3 years old. The previous owner knows they're going to get whacked if they bring a car back that's all beat up. So they tend to take really good care of it. Look, there are some of the cars and coffees guys I hang out with. They go to the dealer. Ooh, that's pretty. How much is that? And they write a big giant check. I mean, if you have that sort of scratch and you don't care about depreciation, knock yourself out.
Right. So our millionaire next door guy, he doesn't have to spend a ton of money on this if he wants to make it a hobby or something to do. Now, we got extreme polarization of answers when this guy said, listen, I want to buy a Porsche, but I feel like I'm a fraud. And I said, buy it. Who cares what people think? And then I was picking up my daughter from soccer practice this week, and one of the dads picked up his son in a Porsche. And I thought, okay, if you have little kids, you can't do it.
That's too
egregious.
That actually isn't true. There's a YouTube channel from a guy who's a deep Porsche dive. He buys a GT3 Touring, which is the race engine, but sort of toned down, no big wing. It's not as look at me as some of these other cars, and it doesn't have a back seat. And there's a company that will custom install back seats
on the roof.
No, in the back of the 911. The funny
Sidecar.
thing is, my 88 is probably the same size as your 2010 Boxster. The 911 just keeps getting bigger and bigger. All cars are getting bigger, 911 also. So you have these cars. Let me give everybody who's interested in doing this a couple of resources right now. So first, anytime I'm thinking about a car, the first place I go to, by the way, unsolicited, unpaid
Yeah,
endorsements.
Porsche should be sponsoring this episode for us.
Right?
We've been giving them a lot
Right.
of good pub
So
lately.
autotempest.com is a website. It's a giant relational database, and you say, I want to see these cars at this price and at this this model, this make. I want it with a stick. I want a convertible. Like, you give it all the qualifications. I want it in blue, and it'll find every car that's for sale with those qualifications from everywhere. So that's a great resource. If you get educated, it's not the sort of thing you could just do willy-nilly. You could go to Bring a Trailer. You could go to Cars and Bids. You could go to P-Car, which actually is an auction site that specializes in Porsche. I've purchased cars from each of those places over the past 10 years. I've sold cars at each of those places over the past few years. So educate yourself, figure out what you really wanted. The first nice car I bought, all I knew is that I wanted a stick shift, a convertible, and a butt ton of horsepower. And that's how I ended up with an M6 that I found in Indianapolis, did a pre-purchase inspection, flew out with my wife to Indianapolis, test drove it, signed the papers, and road tripped home, stopping at Falling Waters in Pennsylvania on the way. Like, there are some really interesting things. Just be aware, this is a crazy rabbit hole that you could go down and spend endless time on.
Yeah, see, I would just get the first one I saw. If this was me, I wouldn't spend all that time.
I think there's something else to note here, which is there's a difference in people who are looking for a collectible car and people who are looking for a car to drive, right? Like, I don't know. I've never driven a Porsche, but I'm sure a Boxster is just as fun as a 911 to drive around, probably, right?
So the Cayman is the enclosed version, the coupe version, and there is this subgroup of enthusiasts that insists that the Cayman is a better car than the 911. It not just because it's cheaper, it's mid-engine, not rear engine, it's lighter, it's smaller, it's more tossable. It's like the 1980s era Porsches that, so many people fell in love with. So that's one thing to be aware of. You can't buy the first mutual fund, you can't buy the first stock, you can't buy the first car if you're buying a used car. And none of my cars are garage queens. They all get driven. I take them out on a regular basis. I don't want to just have this expensive, beautiful responsibility that sits in the garage. And, I have buddies who are Ferrari collectors, and the joke is Porsche guys buy cars, Ferrari guys buy odometers, because every mile they put on the car devalues what it's worth because they're relatively rare and relatively collectible. The other thing people, Porsche guys know, they're kind of bulletproof. They're really, German engineering is incredibly robust. They're built to race, so they could tolerate a lot of abuse from people. Just feed them oil and water and get them regular
checkups. You talk
checkups.
Duncan into it. Listen, I'm a Honda Accord guy. Get off the car talk. Let's get to another one.
Okay, well, before we jump off of this, I do just want to, I brought evidence. Ken, a viewer of the show, wrote in, Dan, you can hit us with the visual. He said, I purchased a convertible 2010 Porsche Boxster for $26,000 with 51,000 miles in March. Best decision I've ever made on a car. In addition to the absolute driving exhilaration, it also provides a new community of enthusiasts, Porsche Club of America, etc., as well as the opportunity to learn auto maintenance and repair. Plus, it's an excuse to buy new tools. So, thanks, Ken.
That's not bad.
Yeah.
Nice work, Ken.
Yeah.
All right.
Listen,
drive it to Culver's on Wednesday nights.
Last word on cars. If you don't want to go down the rabbit hole, but you want a cute little convertible to run through the gears and toss about, my first recommendation is always find a 10-year-old Mazda Miata with 40, 50,000 miles. They go 100, 150,000 miles regularly. You can find a really nice one for 20 grand without maintenance issues and relatively low miles.
Once my midlife crisis hits, I'm going to get one.
We'll hook you
By the way,
up,
Duncan was proven right on this question. Way to go, Duncan.
Thanks. Appreciate it.
All right.
Okay. Up next, we had a question from Andy. I don't know. I'm kind of sad to move off of cars. Okay.
Barry could have gone another hour.
Yeah. My wife and I have had a few opportunities over the years to invest in private companies, but we've never pulled the trigger. Recently, I came across the opportunity to invest in a marijuana company looking to fund its expansion in new states. Frankly, I don't even know where to start in evaluating it. I work in corporate FP&A, I don't know what that is, have my CPA, and can review their financials and pitch deck. But beyond making sure the math checks out, I'm not sure I even know what I don't know. The investment would be about 10% of our current investable assets, but we'd fund it through our HELOC. If it went to zero, it would sting, but it wouldn't change our life. I'm stuck between scared money don't make money and am I just gambling? Thoughts?
Okay,
I've got so
financial
many
planning
questions.
and
I didn't know you
analysis.
could use a HELOC for anything outside of your house.
You
Oh,
can, it's just not tax deductible.
Yeah, you can't deduct the interest. It's funny how many pot investment opportunities I've heard from people, from friends, and it must be because this is just a burgeoning industry. But I would say the CPA mind, it's impossible to perform like actual due diligence on this probably. I think you're betting on the person who's running this, and I would expect this investment to be a call option that you will likely expire worthless. That'd be my way of thinking about this. Barry, we've both invested in some startups over the years. Like, how do you think about putting money into this space?
So there's the comment you're investing in the person, not the idea, because the idea is going to pivot 3 or 4 times before they find what works. It is good advice. There were 2 real issues that this questioner raises. First, hey, if you're borrowing money from your HELOC to invest, you don't have money to be investing. That's like, hey, you should
I agree.
never.
That's a mismatch. That's a debt to
Right.
asset
It's
mismatch.
like, it's one thing if you say, hey, I got a few $100,000 or a few $1 million lying around and I'm getting 4% of my money market and I really like this idea, but I don't have any experience in it. What do you think? So first, borrowing a HELOC to put in a private, full-blown non-starter. Like, it's just, so it's going to cost you 6-7%. And if it goes to hell, you're still paying it off for 10 years. Just nothing good about that. But
Yeah, it's like a constant reminder of a bad investment.
right. The other factor is just simply, all right, so you could read their books. What makes you think that you have any special insight into startups, into marijuana business, into this sort of management?
And of all things, weed. Like,
Right.
it's so heavily wrapped up
I've
in
honestly heard
regulatory
just from
stuff.
4 or 5 people talking about investing in like weed fields, and it's I don't know.
Yeah, like
It's
one
because,
political move could change things completely, right? I mean,
but no doubt about that. But the big thing is that there was this gold rush 5 years ago as more and more states started legalizing weed, and none of these profits have manifested. And lots of these companies now, whether they're startups or they're refinancing, they need cash because it turned out that this isn't nearly as lucrative of a business as people originally thought. So not my favorite space. Never borrow money to make an investment like that. And wait, you have 0 experience investing in privates? We haven't even got to the question, do you want to tie up your money for 5 years, 7 years, 10 years, or forever? The illiquidity issue with privates is another factor. That's a big mismatch for a lot of people. And we're now seeing all the Ivy League and big foundations and endowments that need liquidity, that need capital because of the recent policy changes. They're having a hard time getting it. And one way to get it is to take your privates and sell them for 80 cents on the
just
dollar.
assume this is kind of like gambling. You go to the casino, expect to lose all your money.
yeah,
That's right.
10% sounds like a lot. Is that because of the minimum investment? You think that they would be considering 10% of their investable assets?
That's the other thing. That's a decent sized amount as far as I'm concerned.
Right. If you're advising an endowment that wants to put money into privates, you would never say take 10% of your wealth and put it into this one thing. You would say, oh, how much do you want to have of alternatives? Great. Let's find you 5 good pieces at 2% each. Not
And this isn't even a fund. This is a single opportunity.
that they're borrowing money for. This is just wrong on 10 different levels.
All right, do another one.
Okay. So maybe buy a Porsche instead. Bring it back to cars. Okay.
Better investment, maybe.
Up next, we have a question that came in from Twitter, or X. How do we buy the S&P 493? I own some of the Mag 7 individually and more in my S&P 500 fund. I'm way overweight in the Mag 7, and it's hard to diversify away without selling and taking a tax hit.
You know, Bloomberg had a story this week that there's more ETFs than stocks, which makes sense, because of course. But there actually is an actual S&P 493. So I found this from Defiance ETFs called the XMAG. But the thing is, the answer, so there is one that's just the 493 if you want to completely X those ones. But this is a really easy answer because you could buy almost anything, just anything outside of a market cap weight, outside of an S&P 500 ETF or a NASDAQ 100 or a total stock market. So it's small caps, mid caps, equal weight, value, high quality, dividend, international, whatever. Basically anything outside of a market cap weighted U.S. index fund. That's how you diversify. It's pretty. There's a million different options these days. Pick one.
I'm going to throw you two other suggestions for this person. First, if you're using direct indexing, you could take the S&P 500 and say, I work at Amazon. I have all this Amazon exposure. Or I work in semiconductors. I don't want more chip exposure. And you could tune out the sectors that you're already overexposed to. So that's one approach.
Individual companies, that's a cool customization piece of it.
And then Meb Faber over at Cambria has created one of these ETF exchange funds working with Wes Gray that you could put up to 25% of capital into an ETF and without paying taxes, get a diversified portfolio back. So it can't be more than 25% of any single stock. But so let's say you have, I'm making up round numbers, you have $250,000 in NVIDIA and $750,000 in other assorted stuff. You could give that to MEBS, and the symbol is TAX. You could give that, this is like a 1031 exchange. This comes from a real estate tax section, which used to allow you to sell one piece of real estate.
Allows you to defer taxes.
That's right. You're not avoiding them. You're just diversifying and deferring them until you ultimately sell. That's another option worth exploring. Also,
there's a lot of different taxable structures now that didn't exist in the past. You're right.
The technology and software have allowed us to do things that would have taken 8 guys in green visors working in the basement a month to put together, and now it's just push a button. Oh, you want the S&P 500? Well, you could go equal weight, you could go X, you could go, let me reduce my my tech exposure, or you could do this tax exchange. Many options exist.
Right. Yeah, that kind of stuff is probably a talk to an advisor kind of thing too. If you're going down that rabbit hole, not just a new ETF. All right, we got one more.
Okay. Last but not least, I currently use a nationally ranked fiduciary financial advisor to manage one of my retirement accounts. I independently manage my thrift savings plan. I'm on active duty. My wife's Roth IRA and Roth solo 401k, and a shared brokerage account. I'm a long position, buy and hold, believer in American capitalism ETF guy. No individual stocks here. Here's the rub. The account that's managed by my advisor's firm is the poorest performing of the bunch. I've received some good advice from them in the 5+ years I've been with them, but I constantly think about how they come in last every year. They are the highest cost and poorest performing. Is their advice over time worth tens, if not hundreds of thousands of dollars in earnings potential by the time I retire?
All right, you buried the best part of this question. He said,
sorry.
This is from Herbie Hancock, and he says he's using a pseudonym because he's pretty sure his advisor listens to the show. Okay. Yeah. I wonder how many advisors are going to watch.
Sorry if you're watching this, advisor.
So this actually isn't that out of the ordinary these past 5 to 7 years or so. I think there's a lot of clients who buy tech stocks and they in their fund portfolio or whatever in their sidecar, and they have outperformed their advisor. So Barry, I always liked the story that you give about the guy who came to us and said he's going to put equal amounts into 4 advisors, right? What was it? And then whoever is the best after a year.
Right.
Yeah.
Right. And I'm like, you're just incentivizing them to swing for the fences. You've created a terrible game theory that, hey, if I just do risk-adjusted returns, I'm going to lose. So the odds are 1 in 5 I'm going to win anyway. I might as well swing for the fences.
Yeah, if that happens, you send them to me. Yeah.
Yeah. So I love this question for a couple of reasons. So first, savvy investor managing a lot of the portfolio himself raises the question, why is he using an advisor? My assumption is he's in the military, so he needs someone to watch his money when he's deployed overseas or whatever's going on, or heaven forbid, something happens to them to help the wife and kids, pass that. So the first question is, do you want an advisor who you're just going to pay by the hour and not worry about the performance? The second question is, and we've seen this a lot of times, people have come to advisors and they'll say, listen, I'm against global warming. I don't want any oil stocks. And then oil stocks go on a hot run. Hey, why is my portfolio sucking? Well, you pulled out the best performing sector. Or I'm very risk averse and I want a 60-40 portfolio. I don't want a lot of craziness. Because when they opened the account, everything was going crazy, and so they tuned down their risk, and all their other accounts are kind of risky.
Yeah, that does happen a lot where the advisor needs to remind them, this is what you told me to do. And it could be that whatever you're investing in, maybe the advisor knows it and they're trying to offset that and hedge it in a way. But I would pull up my meme here. I would sit down and talk with them and have a discussion like, what do you do here? Like, what am I paying you for? I would just put it out there and say, okay, walk me through why is my performance always better than yours? Are you trying to offset something? Are you more diversified? It could just be that they have all their money in U.S. stocks, and this person has, and the advisor has bonds and cash and REITs and small caps, and they have more diversification. So it could be as simple as that. But I would ask the advisor, like, just explain it to me. Why is this happening? What else are you doing for me? And if they can't provide any good answers, and they're not providing any really good financial planning, then maybe you don't need to use them. That I would ask them, like, what are you providing me for your services? What am I paying you for? That's a legitimate question. Any advisor should be able to answer.
Also ask them, why am I in this portfolio? What else do you offer? You know, every now and then we'll take over a portfolio from somebody, and it's kind of funny to say, you're in this incredibly conservative, risk-averse portfolio. You should be in an 80-20 or 70-30 or something like that. Why did you choose this? And the answer is almost always, I don't remember the conversation that led to this. At my old advisor, that's why I came to you guys. So find out if this is the appropriate portfolio for where you are today. Find out what else they offer, and consider whether you want to work with, you know, an hourly portfolio, an hourly advisor who's not going to be managing your money. It looks like this person is doing trust work and tax work and estate work. That's a different conversation than somebody who's, here's a plan, now I'm going to...
But yeah, maybe it's also, to your point, maybe it's a risk tolerance kind of thing too, and they're not taking enough risk, and maybe that's what you want. But yeah, you have to have a conversation with them. They should be able to be transparent and honest and tell you what's going on. So I would have that conversation.
The challenge with risk tolerance is how much recency bias creeps in. When the market's making all-time highs, people say, hey, I'm very risk tolerant, I'm very aggressive, let's go.
So were you saying this in April that you'd wanted to take more risk, or
right.
2022? Yeah, that I agree that some people think they could take more risk. Their perception of risk changes, not necessarily their appetite for it.
Right. And, you know, if you have the same conversation late 2022, listen, I'm not looking to shoot the lights out. The market is down. Bonds are down. I want to be conservative.
Yeah, I'm good. T-bills are 5%. I'm good.
I'm getting 5% of my money market. I don't need to take... So, you know, all that stuff should be really clearly written out. It's why advisors are supposed to keep running notes. We use Salesforce. There's a dozen different technologies for that, where, hey, when you set up this account in 2022, you said, I can't tolerate loss. I don't want volatility. Put me in something very conservative. Well, conservative means that when the market comes out of this, it's going to underperform the stocks that we're getting and the funds that we're getting shellacked in a down year like 2022.
Would it be fair for the advisor to say, you know, we're looking at 10 and 20 years, not the last 3 years?
Yeah, well, that's...
Or is that a cop-out?
There's some element to it. It has to fit the client's goals. And if you're 25 or 55, they're going to be two different portfolios. So there needs to be a good fit. And yeah, a year or two is too short to judge. But after 5 years, hey, why am I in this portfolio? And it sounds like we haven't talked about, he said not only was this the worst performing portfolio, but it was the highest fee portfolio. And the recent Morningstar report, which echoed their 2011 report, which echoed a dozen separate academic researchers, are, if you know nothing about a portfolio and can only learn one thing, make that fees, and that'll give you good insight as to how it's going to perform. Higher fee portfolios have a tendency to underperform.
All right, we didn't get him a Porsche, but it is Duncan's birthday today. And,
happy birthday, Duncan.
Yes, the Compound Media team prepared a few pictures for Duncan.
Oh,
so
no.
Daniel is going to put some pictures up here that they created. There's Duncan on his Beatles tour when he went on his London trip earlier this year. That's pretty good. Duncan's a big F1 fan. He's very serious in the car.
I like it. Alpha.
Yeah. This is Duncan in his Oatly world, I guess.
And that's my dog. That's Wally.
That is your dog? Okay.
Horseback on Wally.
That's unbelievable.
Wow.
Oh, that's pretty good. So
That's,
that's from the Compound Media team. Happy birthday to Duncan.
Thank
We'll get him a
you.
Porsche hat, maybe.
Oh,
Yeah,
that's
very
great.
good. I'll take
All right.
it.
But
or
wait, Barry, so I just
diecast.
want to make sure. You don't say Porsche, you say Porsche?
Who knows?
I match,
cares, right?
honestly, I match whoever I'm talking to usually. If it's someone who says Porsche, I'll say Porsche, but otherwise, it's like a pinkies up thing. You know?
If
Pull
you're
it
in
off.
Germany, it's Porsche. It just sounds so affected in the United States.
I
to
agree.
say
Right.
Porsche.
All right.
Right.
askthecompoundshow@gmail.com. Hit us with your emails and questions as always, and we'll see you next time.
See you, everyone.